I am Ava Makinar, and this is the Coin Daily. Traditional risk assets caught a textbook relief rally today. Stocks surged, volatility cooled, and the dollar pulled back, an environment that would usually drive crypto higher. But the majors barely budged. Bitcoin, Ether, and the rest are still trapped in some of the narrowest trading bands we've seen all year. And even as breadth finally shows signs of waking up, price action refuses to break out, with every attempt fading fast. What's driving the story now isn't fresh headlines or explosive news. It's the internal mechanics: funding turning negative, traders crowding into short derivatives on names like Polkadot and Uniswap, and positioning, not headlines, setting the tempo. We're in a moment where what happens inside the market matters more than the bigger macro moves. Even as internal flows define the market, the rules around who can participate are getting a serious overhaul. This week, the Treasury is raising the compliance bar for stablecoin issuers with a set of new rules that feel a lot more like bank regulation than anything crypto-native. The US. Treasury just dropped its long-anticipated rule proposal for payment stablecoins. The message is clear. If you're minting or redeeming a permitted payment stablecoin under the Genius Act, you'll need a full suite of compliance controls that look more like a regional bank than a lightweight crypto startup. That means a board-approved anti-money laundering program, a US-based compliance officer, independent audits, and ongoing checks, not just on customers, but also on any business partners. The technical bar is higher too. You must be able to block or freeze any transfer that runs afoul of state or federal law, and those controls cover both new coins and anything traded in the secondary market. Transaction monitoring is now required for every transfer over $3,000, and annual sanctions training is mandatory. Every transaction will have to be screened against OFAC lists, with record-keeping at a far deeper level. Two big unknowns remain: exactly who counts as an intermediary, and how wide-reaching these rules will be for other players in the ecosystem. For now, the direction is what matters. Payment stablecoin issuers are being pushed toward the same sort of compliance burden as banks, and the crypto rails they run on will need to keep up. With regulation stepping up, access to crypto rails is getting more controlled. At the same time, Wall Street is bringing new products to market, but even as institutional money comes in, the price action barely moves. Morgan Stanley made headlines today with the official launch of its spot Bitcoin ETF, trading under the ticker MSBT. They kicked off with over $34 million in first-day inflows and more than 1.5 million shares traded. That's a strong tally for day one, but what really stood out was the total lack of fire in the price. Bitcoin's chart was about as compressed as it gets, almost daring the market to care. So the question is, why didn't this new Wall Street demand spark a move in Bitcoin? Bitcoin traded in an unusually tight box, less than $200 wide, with a hard floor at $70,757 and a ceiling at $71,118. The launch barely made a dent in this range. So the headline is clear. You've got a brand new US spot Bitcoin ETF from Morgan Stanley Investment Management, trading under the ticker MSBT, with a sponsor fee of 0.14%. And the first day numbers were meaningful, around $34 million of inflows and more than 1.6 million shares traded. And yet, Bitcoin itself barely reacted, sitting in that tight band, roughly 71,122 to 71,306 for much of the session. The takeaway isn't that the ETF doesn't matter. It's that, right now, crypto's follow-through is weaker than the broader risk-on tone, and the market is demanding more than a single launch day print before it reprices. The next question is whether those flows build over days and weeks, and whether they translate into persistent spot demand. Because that's what eventually forces a breakout from a compressed range. Headline moves might not drive price, but global politics still has a knack for stirring up tension. Today's fresh reports from Iran remind us how quickly unexpected macro shifts can hit, even if the crypto angle is thin. Iran has reportedly started charging large tankers a toll, supposedly as high as $2 million each, for passage through the Strait of Hormuz. Reports say some payments have been asked for in Bitcoin or Chinese yuan, but most documented transactions are in yuan. It's now a toll booth operation, with ship owners having to submit ownership and insurance details and seek approval to cross. As for the Bitcoin story, the chain of evidence is much weaker. There's no clarity about which official entity would receive the crypto, how such payments would be processed, or how banks and insurers would handle the sanctions risk. This isn't a proven new payment rail for oil shipments, it's just a new layer of friction in an already tense region. The bigger point is that whenever geopolitics shifts suddenly, the market can see a spike in volatility, even before all the facts are verified. That kind of geopolitical flash just adds to the background noise, but the main story is right at the heart of crypto itself. Why have the majors lagged when every risk asset outside this space just ripped higher? This is where the market narrative really shifts from headlines to data. Traditional markets just gave us a textbook rally. Stocks up sharply, the VIX down, and the dollar giving back ground. Normally, that combination lights a fire under crypto. Today, Bitcoin slipped just under 0.5%, Ether dropped 2.34%, and instead of trending higher, everything just got quieter. So what's really pinning crypto down? Underneath, it isn't as simple as risk-off. Breadth actually snapped back, with more tokens catching a bid, and there were no signs of forced selling. Instead, the majors compressed into some of the tightest bands all year. A lot of that comes down to positioning. Funding rates on Bitcoin flipped to -3% annualized, signaling traders are paying to stay short. Open interest is down more than 4%, just above $6.5 billion. So risk is being trimmed, but not flushed. On Ethereum, it's the same pattern. Funding is at -5%, open interest is off by nearly 9%, and still no massive capitulation. This is not full-on panic, it's a slow reset, traders pulling leverage without rushing for the exits. Another angle is flows. Spot Bitcoin ETFs saw more than $370 million in outflows. Ether lost nearly $80 million. So, new money is not rushing in, and that's part of why the majors stay boxed in. If you're trading this, focus on the range and the evidence. Bitcoin is stuck below 71,306, open interest is down, and funding is negative. If price takes back 71,306 while funding holds negative, that's your early risk-on signal. If not, expect more chop and lag. The pivot, right now, is all about whether ETF flows and positioning can break the deadlock, because it's clear, macro tailwinds alone have not been enough. With the majors in a holding pattern, the bets have shifted toward deeper corners of the derivatives market, especially in places where the crowd is leaning hard in one direction. Polkadot and Uniswap have become the prime example. Right now, Polkadot and Uniswap are textbook crowded trades on the short side. Funding is so negative, shorts are essentially paying a high premium to hold on to their bets, but open interest hasn't tanked. That means most short sellers are still in. And with price hovering at key levels rather than breaking down, the risk is building. Crowded trades like this only need a spark to reverse. Polkadot's funding rate is deeply negative, down 56% annualized. Uniswap sits at -24.5%. Bitcoin, XRP, and Chainlink are also negative, but not as extreme. The comparison shows just how crowded these Polkadot and Uniswap shorts are. Here's what crowded shorts actually mean. When funding is this negative, short traders are paying long traders a fee just to stay in the trade. In a strong downtrend, that works. Momentum keeps paying off. But when funding is deeply negative and open interest only drops by a few percent, around 4% for Polkadot and just under 4% for Uniswap, It signals that the majority of short bets are still open. So you get a crowded theatre effect. Traders packed on one side, and just a little squeeze can force a lot of exits in a hurry. For Polkadot, the level that matters is a move back above 125.6. For Uniswap, it's a push over that 310 to 3085 band. If price flips those levels while funding remains this negative, it's classic squeeze fuel. Shorts could be forced to cover, driving price sharply higher. Until that happens, each new breakdown struggles for momentum. Watch how quickly shorts rush for the exits when the pressure swings back. The crowded side always moves fastest when the door opens. Crowding and compression are dominating the bigger names. But in the altcoin trenches, a few standout trades are still offering cleaner break or fail decision points. Sui is at the top of that list tonight. Sui jumped nearly 9% in just 4 hours, bouncing strongly off 90.48 support, and now pressing up against the key breakout zone at about 91.37 to 91.39. The main story here is whether this rally can turn into a clean breakout or just ends up as another false start at major resistance. The Sui price chart shows a strong move up to resistance at 97.21, holding above support at 90.55. Price is boxed just beneath the breakout zone, and buyers have momentum but need confirmation. That's the technical picture, but Sui's derivatives setup isn't overheated yet. Funding is only a bit positive, and open interest is down about 3%, which means traders aren't blindly chasing the move. There's directional interest, but no one is jumping over each other to get long. At least not yet. Sui is trading around 90.9 with resistance at 91 cents, the breakout target at 91.04, and a key retest at 90.92. The trading range is very tight. For Sui, it's a simple if-then playbook. If price can break, and hold. Above 91.39, with buyers defending any retest, the next checkpoint is up at that 97.21 resistance. But if the move stalls and loses support, the setup flips back toward mean reversion and consolidation. For now, Sui is one of the few tokens where the levels and the positioning give a clean map. You just need to watch who wins the fight at the line. Across the board, the split is obvious. Macro tailwinds are blowing and stocks are on fire, but majors like Bitcoin and Ether are locked in, and the cleanest action is hiding in crowded alt trades or breakout setups like Sui. Whether this divergence eventually resolves with a squeeze or a new wave of conviction depends on where the next flows land. Spot, perps, or somewhere else entirely. The next move in majors likely comes suddenly, so keep an eye on how that deadlock breaks. Does this split between risk-on stocks and locked-up crypto signal a bigger move coming in majors, or is the action really all in the crowded alt bets? Subscribe and you'll get this every evening, plus shorts throughout the day whenever something moves.